Hey everybody, I'm Mike DeSepoli and welcome to the Heritage Market Update for Wednesday, January 19th, 2022. Hope you're all having a great week so far. We have a lot of information we want to bring you up to speed on here today. You see the headline here on Bloomberg, stocks fall as NASDAQ sell-off hits a 10% from high, which is characterized or defined as being a correction. We think it's much ado about nothing. It's more about terminology. When anytime stocks fall, people don't like it, whether it's 8, 9, 10, 12% or more. But nonetheless, we are officially in correction territory. We're going to tell you why. We don't think that's going to last much longer. But nonetheless, we see the market still has some work to do in these areas to work off some of the volatility that we have seen recently. So let's take a look at the markets here so far today. Dow Jones up 93 points, S&P up 7.77, and the NASDAQ Composite up 58.46 points. Bouncing back after a rough day yesterday, we saw a lot of weight and pressure on the market after a three-day holiday weekend. We got some news yesterday morning, the Empire Manufacturing Survey, which gauges economic activity in New York and in the Northeast region. We saw a very big miss yesterday where the gauge showed contraction. So there are certainly some signs lining up that the economy is slowing a little bit. We do think that this fits into our thesis about how the Fed is going to react and respond later this year. But let's take a look at the market first and see where we're at. Looking at the NASDAQ here, right? This is the NASDAQ over the last 9 months. We've been really in this corrective range now for the better part of a couple months. And we're seeing the market here coming back down to retest an area that we previously had seen late September and early October. So very normal of markets to probe around. We're visiting or revisiting the scene of the crime here. We did have a good level of support in the market the last time we saw these levels. So this is what we're watching to see. How does the market react and respond as it gets down into this range here? We do think this market still has legs and still has plenty of room to move to the upside. But nonetheless, the narrative around the market has become so negative and the mood of many investors has soured. So we're seeing a lot of weakness in the market where opening pops in the morning are getting sold and the market is giving way under its own weight in the afternoon. This is generally how most corrections play out, right? Where they tend to be prolonged. We see a lot of volatility. Some of the bounces get sold as nervous investors continue to reshuffle their portfolios. So this action can make you nauseous, can make you seasick. We understand it, but this is something we've seen before. We know the playbook and we know how to play it. So then that's why you have us, right? Is to help us determine when is it just heartburn or when is it heart attack, I should say. When is it time to fold up our chairs and get out of here, or do we need to hold firm and hold strong because we think there's better days ahead? And that's what we see here, and that's what we believe. Now, let's talk about interest rates for a moment because that is the conversation that's weighing on the market. The market hates uncertainty, and we're certainly getting a lot of uncertainty based upon all the speak and comments that have come out of the Federal Reserve. Now, it's widely anticipated the Federal Reserve will raise interest rates this year. The big debate is about how quickly, how much, and how often, right? So at current, with current data and current futures probabilities, the Fed will probably do something in March. Now, we're of the opinion that the actual rate hike itself will not be damaging to markets. It's all the posturing that leads up to that point and the uncertainty surrounding that event that's causing anxiety in the market. Markets race to price in future events, right? So all this chop we're seeing here in the market, this is the market pricing in the probability of interest rates. Now, we've seen some forecasts as high as 5, 6, or even 7 interest rate hikes this year. And I'm here to tell you why we don't believe that'll happen. Is number one, this tightening of monetary policy that we keep hearing about that the Fed needs to deploy. It's already happening right before our eyes, folks. As the 10-year Treasury yield rises, which we have seen, this is the yield, or this is the bond area of the bond market that affects mortgages, loans, and different borrowing structures, right? So we've seen mortgage rates go up over the last month and a half, 2 months. We've seen auto loans, the rates attached to those go up. We've seen home equity lines of credit, the rates attached to those go up. So all these different financial lending institutions are not sitting around waiting to see what the Fed is going to do. They have already marginally increased rates, which means the tightening in the economy that the Fed really is kind of being projected to embark on is already playing out in front of us. We're also seeing as equity markets have sold off, This is, in essence, a tightening of monetary policy, right? Because as investors see their equity values go down, less available dollars, they tend to hold on to them a little bit more closely, less spending, and that is anti-inflationary. So we're making the case here that a lot of the work is being done in the bond market for the Fed. Now, that doesn't mean they won't raise rates. We do think that we'll see 1 to 2 this year, but it's not going to be 5, 6, or 7. And I think once that event is out of the way, we get that uncertainty out of the market, it's going to be a major hurdle that this market will clear and it will be ready to move higher. Now, somebody brought something to my attention yesterday, a great comparison of the current market to the market of certain stocks back in 2008. And there was one in particular that caught our eye that we wanted to share the story with you because we see a lot of similarities. Now, this here is a look at the chart of MasterCard, right? And when we go back into 2008, right, here's MasterCard. They were a newly public company in 2006. And obviously, talking about MasterCard today, it sounds like a very stable company, a growing company in a great sector of the market, basically a blue chip stock. But that was not the case back in 06, 07, and 08. It was a newer company to the market. Credit cards were really just starting to take off. And we had this stock MasterCard that debuted on the market and went on a very big run higher, right? It ran from 5 to 30 in a very parabolic move. And then all of a sudden, 2008 came along and we saw MasterCard get chopped more than in half in less than 6 months, right? And it was at this point right here that everybody said credit cards are a fad. It's a trend that's going to go away. All the people that bought the stock up here were going to be called bag holders because they were never going to see any return on their equity. And, this is reminding us very similarly of the period we're in now, where people are discounting growth and innovation as if we'll never need it again. They're discounting e-commerce and technology and software as if we'll never need any of these things again. And maybe we won't, but I'll take the other side of that argument that those are going to be very big components in the U.S. economy for many years to come. Well, we know what happened next with MasterCard. After this big precipitous decline that shook a lot of people out and convinced them that it was a terrible idea, we saw MasterCard go on a 10 to 12 year parabolic run where the stock went from 15 to 364. Now, you might be asking yourself, why, Mike, why are you telling me this? Why is this relevant? Well, folks, we very well may be looking at a very similar case with several of our stocks, but one in particular would be PayPal, right? PayPal has not been on the market for that long. We're talking about 6 years or so at this point. There's been a lot of hype around this stock, the future of fintech, digital money transfers, e-commerce, et cetera, et cetera, et cetera. And really, just as recently as July of 2021, everybody was loving this stock. And now this stock has had a precipitous decline, has many people questioning the future of e-commerce, questioning the future of digital currencies and digital payments. And we think that these doubts and these fears are very much misplaced. And sometimes when the market gives us opportunities like this, instead of running scared in the other direction, we need to step into these types of opportunities and buy them and hold on tight. So I tell you this story because we do see similarities across many stocks. And many of you might be wondering, why are we holding some of these stocks that have acted like this over the last couple months? Is because in the example of MasterCard, right, when you catch one of these at the right time and you're able to hold through what perceivably is an irrational period in the market because you have a good company on hand, these are the types of events that we can see unfold. And remember, MasterCard investors, it wasn't an easy road for them. They had to hold through this pullback and this pullback and this pullback and this pullback. But nonetheless, this is why we take our focus on these investments. We want to look at fundamentals and technicals in the near term, but we also have a longer term focus on where these stocks can go and what their potential can be. Another chart we want to share with you here today, and let me just move myself out of the way so we can see this. So this is a look at the NASDAQ Composite Index, and down below we have two charts, the first of which shows the percent of all stocks in the NASDAQ that are down 20% or more from their 52-week high, and the chart on the bottom shows the percent of stocks in the NASDAQ that are down 50% or more from their 52-week high. So just to show you the level of carnage that has happened under the hood of this market. So folks, we're seeing about 70% of stocks in the NASDAQ are down more than 20%. And about almost 42% of these stocks are down more than 50%. Now, it sounds like a bad thing, but when you look back to previous instances when we saw readings this high, this was the March 2020 crash, right? And obviously, the index gave up a lot more in that period of time than more recently here, what we're looking at on our screen. because some of the mighty tech titans have held this market up with their performance. But the last time we saw readings like this, the NASDAQ went on to double in the next 18 months. And again, not that we're calling for the market to double from NASDAQ 14,800, but these types of signs in the market are impossible to ignore. We rely on this data to help guide our decision making. And this is what is telling us that the market is acting very irrationally. There's a lot of opportunities in this market, and this market's getting ready for a move that we believe to be higher. So it's not time right now to scrap the game plan, change course, and to look for other opportunities. So that's how we think this is going to play out. But nonetheless, we know that these periods of time can be challenging in the markets. Corrections can really take their toll on investors, create a lot of emotional stress. So we're here to help you, guide you through. This isn't our first rodeo. We've seen this playbook before. We know how the market behaves anytime the Fed starts to intervene with interest rates. We tend to have that period of angst when there's a lot of uncertainty around what they're going to do. But once policy is clear, once the Fed embarks on that path and the market is able to fully digest it, we expect that there's a lot of good days ahead of us. So if you have any questions, please reach out to us. I wanted to share some additional insight with you today, draw some comparisons to markets of past. Because while you know what they say, history does not repeat itself, it certainly tends to rhyme, and we believe that's going to be the case here too. So we hope you have a great day. If you have any questions, reach out to us. We'll see you back on Friday for the Heritage Market Pulse.